Welcome to Kaplan Professional Education's monthly economic update. This month we're speaking with David Bassanese, Chief Economist at BetaShares. Thanks very much for joining us, David.
Thank you, Michael.
The last few statements on monetary policy by the RBA have been accompanied by the comment that the economy is likely to have a degree of spare capacity for some time yet. Which sectors do you think will eventually pick up this slack?
I guess the economic framework, it's going to be the trade-exposed non-mining sectors, because they're going to most benefit from the weakening dollar that we're seeing. So areas like tourism and manufacturing, we are seeing a turnaround in tourism already. Manufacturing is going to be slower to pick up because it's more capital intensive. So they're going to need to see a lower dollar for longer before there's the incentive to invest. We are also seeing domestic services picking up as well. So areas like health, education are showing good employment gains as well. So the transition in the economy is happening, but I guess it's not happening as fast as many would have hoped, because the unemployment rate is still up around 6% and the outlook is still for below trend growth of around 2 to 2.5% over the next year.
Are we likely to see another rate cut if consumer confidence doesn't pick up soon?
I think there's more rate cuts to come. My base case is that the RBA will cut to another 2 times actually next year on the back of not so much. I think consumer spending is struggling, and it's 50 to 60% of the economy, so that's important. The problem is, we're not getting a lot of income growth. So we've had reasonable employment growth, but it's sort of, again, talking about the transition, a lot of it is in the services area where wages tending to be lower than what they were in the mining sector from where the jobs have gone. I think growth remaining weak, unemployment's eventually going to push up through 6.5%, and that will be the catalyst for the RBA to at least be seen to be doing something by cutting interest rates.
Where do you see the dollar heading in early 2016, given the likelihood of a US rate hike this month?
Yeah, I think the rate hike from the US is like the new, where everyone's sort of been talking about that happening, and now it's becoming a reality. I think the Fed have more or less announced that December's the base case at the moment, and so the dollar's now breaking below 70 cents. It's around 70 cents now. My year-end base case has been for most of this year that it would hit 68 cents by year-end, and so I think that's still on track, certainly with the Fed raising rates. And I'd see it going down to around 65 cents by mid-2016. And if you want to actually push it further out, 58, 60 cents over a 3 to 5 year view is not out of the ordinary. That would basically take the Aussie back to its long-run average in real terms.
What's your overall outlook for the Australian economy going into 2016?
Look, the outlook is not flash. I mean, the economy is transitioning from the mining boom, but the transition is slow, and it's in basically lower wage areas of the services sector. So I'm looking at growth remaining subdued around 2 to 2.5% over the coming year, which should be enough to push up the unemployment rate. And if you just break it down, we've got mining investments still expected to fall further. The business surveys are telling us that non-mining investments not really picking up all that much. Household sector is constrained by lower wage growth, so incomes growth is constraining what households can do. And I guess the bigger issue for the economy next year is the housing sector, which has been a strong contributor to growth, is looking as close to a peak. And so the risk is that the contribution to growth from the housing sector is actually going to fall away next year. So, even more challenges for the economy.
Turning to the US, expectations are high for the Fed to increase rates this month, a live possibility, as Fed Chair Janet Yellen said. What's your prediction?
I've long thought that the Fed should raise interest rates. I think they've been behind the game, and Janet Yellen has recently come out and said that December's looking likely. We had a very strong payrolls report recently. So I think now the markets are correct in that December's looking likely. Now the question then is what they do thereafter. I don't think next year they're going to go back to back in terms of raising rates at every meeting. So we may see them raise rates at one meeting and potentially hold off for another meeting. And so the important meetings next year are in March, June, September and December. These are the meetings where they also update their economic forecasts. So, my scenario would be they maybe raise rates in December, hold off in January, there's another meeting in January, and go again in March and follow that sort of pattern through next year.
So what will be the drivers of the US economy going into 2016?
Yeah, look, the economy has been going pretty well in the United States, principally driven by the consumer spending, which in turn is driven by employment growth, and also the housing sector has had a nice upturn. So they've been the two key drivers, and I think that's going to continue. Lower oil prices have certainly helped real incomes in the United States. So the bottom line, it's going to be a continuation of consumer spending and housing investment recovery. Business investment is contributing a little. I wouldn't expect a lot, and also the export side of things is going to be a bit constrained because of the rising US dollar and a weakness in emerging markets.
Just looking at China, we've seen a few wobbles this year with GDP growth in the third quarter slipping below 7%. What will you be watching as the authorities attempt to transition the economy from investment-led growth to private consumption?
China's interesting because I've been talking about the transition, obviously, from investment to services, and we're seeing that in industrial production. That's falling away. What's interesting, though, is the services side of the economy and consumer spending isn't picking up. It's still holding at pretty good levels, but it's not accelerating. So net, you are getting a transition, but its growth is still slowing down. So I wouldn't expect to see a big turnaround in the consumer sector of China. I think it's still going to keep growing as strongly as it's doing, but it won't accelerate. The issue to me is how quickly will the industrial side of the economy slow, and that's we haven't seen a bottom in that yet. That's continuing to slow. So that's the key thing I'd be looking at in China, and indicators there would be in the housing sector, for example. We're seeing tentative signs of stabilisation there. We're seeing some infrastructure programs being announced again by the government. So these things may hold up industrial production. But at the moment, there's still seems to be more downside to go in that area.
And what's your overall outlook for China in 2016?
China is slowing down. I think growth of around 6.5% to 7% next year seems likely, and people shouldn't be scared about China. You got to remember, only a few years ago China was growing at 10%, and it's since slowed down to around 7%. And over the next few years, I think there's going to be an orderly slowdown to around 5 to 6%. Just again because the economy is getting bigger. Income levels are rising, so the productivity catch-up to the rest of the world is diminishing, and that there's less scope for productivity catch-up. And plus, population in China is slowing down. They've recently changed their one-child policy, but that's going to take a while to affect, obviously, the labour force. And so the demographics aren't fantastic for China either. So an orderly slowdown would be my base case scenario, and that would be, the big issue for China is provided people have jobs and they're not, demonstrating on the streets, then all is well, and I think that's going to remain the case.
And finally, to Europe, what impact do you expect factors such as lower growth prospects for emerging markets, disruptive adjustment in China, and the normalisation of US monetary policy will have on the region?
The emerging markets in China are an issue for Europe because exports are an important source of their growth. And so they are seeing some signs of a slowdown there. So that's an issue. The rising US interest rates, on the other hand, can actually be a net benefit for Europe because it's probably going to weaken the euro. So net you're getting, on the one hand, their main trade partners are slowing down. On the other hand, they're becoming more competitive vis-a-vis the United States. So again, I don't think it's a serious issue, but it's certainly one to be looking at. And the other area I think that Europe is benefiting is consumer spending, which is picking up because of the weakness of oil prices. And so the European economy is gradually recovering. Is still doing reasonably well. Unemployment is falling, and so I think continued steady progress, and even with these negative factors.
As well as consumer spending, what do you expect to be the drivers of growth in Europe heading into 2016?
Again, I think exports have been an important one, but that's going to be the risk factor. I mean, you've got the European Central Bank looking to stimulate further, which potentially could lead to a turnaround in business investment. But at the moment, the underlying demographics of Europe are not fantastic, so they do rely on on exports to a large degree. And again, I go back to the windfall from weaker oil prices will be important.
Thanks very much, David.
Thanks a lot, Michael.